Happy Tuesday.
Hey, everybody. Happy Tuesday and welcome back to everyone that's returning. Welcome for the first time if you are new here. And good morning, good afternoon, good evening. I see that we have people from a whole bunch of different time zones that are joining us today, Mr. Stoffel.
Yeah, Norway, India, Pennsylvania, Tampa, Fort Myers, Nashville, Boston. I'm coming from Wisconsin. Where are you, Mr. Feroldi?
New England. So thank you guys so much for joining us today. We are going to do another deep dive into two stocks, battling them against each other, researching them as we go, and trying to figure out which stock is the better buy today. Mr. Stoffel, do you know what stocks we are researching today?
You bet I do. I've been an owner of one of them for a long time. Don't currently, as of today, but cybersecurity is the name of the game here. We've got CrowdStrike. That's the one that I've owned. We've got Palo Alto. That's the one that I have not.
Yep. These are two fabulous long-term investments. Both of them have smashed the market, going at it in different ways. And we are going to take both of these companies through the Simplifier 7 framework today. So we want to know, are we talking to shareholders here or prospective shareholders? Let us know in the chat if you are a shareholder of either of these businesses. Mr. Stoffel, are you a shareholder?
Yeah, so at this moment, I'm not. I think that CrowdStrike is a phenomenal business. You will see when we do the valuation why. It has ended up being a very good, I'll show you where I bought and sold, but there are some hefty expectations, hefty.
I'm sure there are. I am a shareholder of CrowdStrike. I am not a shareholder of Palo Alto Networks, but it'll be fascinating to look at both of these companies with kind of fresh eyes, if you will, and see where we end up here. Now, some companies are easy to analyze. Some are moderately difficult. Some are hard. And some require PhD level understanding of accounting and business to do so. Just out of curiosity, where would you put these companies on the difficulty scale?
I put them in the medium category. This is, if you understand SaaS, they're not purely SaaS, but I mean, if you understand SaaS, you probably get this.
Yeah, I said hard, but it's probably hard to understand what makes them different, or like the
Sure.
security layers. The business models of at least the business model is very straightforward with CrowdStrike, or at least it has been historically. All right, so let's pop on over to Stock Simplifier. This is the research tool that we are going to be using, and let's go ahead and start. Do I have a category called cybersecurity? Look at that.
Yeah.
We do have a category.
And they're the first two.
Yeah, there you go. Yeah, you go. CrowdStrike and Palo Alto Networks. So go ahead and choose CrowdStrike there. All right. This company up 260% over the last 5 years. When was that outage crisis? Was that?
So the outage was right there. Yep.
Yeah.
That's it.
It looks like nothing in retrospect.
Yep.
This was national news. They're causing planes to go down.
Yeah, not planes to go down. Just to be clear, no planes crash.
Correct. You're correct. Yes, the airline systems were gone down. But look at that. So if you bought this stock 3 years ago, almost a 4-bagger, right? Since then,
almost
so just
a 5-bagger.
Yeah, just a look at this. Actually, you bought an IPO in 2019, a 13-bagger, just absolutely smashing the market. 45% compound annual return if you bought at IPO. So sensational company. $200 billion market cap, 10,000 employees, founded about 16 years ago. It's a subscription style businesses.
Love that.
Quick checks. So profitability.
Wait, I'm sorry, but first, look at that mission. I put that top 5 all time.
We stop breaches. Yeah. 3 words.
Love it.
How hard is it to get a mission of a company down that succinctly?
Yep.
It's a rare company that can do it that beautifully. So you are absolutely correct. One of the best mission statements in all of public company land. All right, quick stats. Gross margin 75%. Operating margin -6%. Net margin -3%. But
stock-based compensation.
Look at their free cash flow margin, 27%. This is a jaw-droppingly good number. And the difference between these two, it's got to be GAAP versus non-GAAP stock-based compensation. Balance sheet, $5 billion in cash, only about $1 billion in debt. Great balance sheet. Growth rate, 29% compound annual growth rate over the last 3 years, 65% over the last 10 years. Free cash flow is compounded 34% annually over the last 5 years. Valuation, 44 times sales and 163 times free cash flow, and no meaningful capital return program to speak of. All right, let's start digging into the business. CrowdStrike sells cybersecurity as a cloud subscription. So customers rent their defenses from a specialist instead of building and running them in-house. Pretty straightforward.
Pretty straightforward.
There's the Falcon platform, which is one lightweight sensor that sits on every computer, server, and cloud workload, and feeding a centralized cloud server that spots and stops attacks. That's the Falcon platform. Modules, a catalog of add-ons that cover endpoint, cloud identity, data, and data security, each switched on without deploying anything new. So once you have the Falcon on your thing, they can add additional add-ons easily. Mm-hmm. Professional services. Security endpoints handle incident response and proactive assessments, often becoming the entry point into a subscription. So something happens, you hire them, they bring people in, they get you set up, and then there you go. What makes it distinctive? Rivals ship a new agent for every new capability, while CrowdStrike ships another module on the sensor already installed. So
the key thing here, so this is a stock that I've owned since 2020. So I bought it very shortly after it IPO'd, is that it has a lightweight agent. And the whole idea behind a lightweight agent is it's a simple thing to install on whatever, your phone, an endpoint, computer, whatever. And then it's got the graph, the Falcon, like it's got the security graph in the cloud. And so the lightweight agent can send things to the graph, and the graph can send things to the agent, but it doesn't take up all the compute to run this on your endpoint, which is a pretty big deal.
Yeah. So it doesn't slow down your personal computer or whatever it's on, because all the processing is done elsewhere. Okay. Who are the customers? The buyer is an organization that has decided its computer and cloud need better protection than traditional antivirus and would rather rent than build it. So large enterprises, the public sector, federal agencies, defense customers, and state governments buying a certified regime. 25 of the 50 U.S. states have standardized on it. Ooh. Mid-market buyers and breach responders. So if you have an incident, you kind of hire them to go on there. So it's a cybersecurity company selling cloud subscriptions, and its Falcon platform is the key product. All right.
The other just key thing to note is they were the first cloud native cybersecurity company, which is going to be important when we compare this to Palo Alto.
Founded in 2011. So the cloud was a burgeoning, growing thing back then. Okay. Probably my favorite two visuals on all of Stock Simplifier. 95% of their revenue is subscription-based. 5% is professional services. This is why we show you this, because if you're like, oh, like they have this the professional services, well, it's 5% of the business. Now, growth rates, the overall subscription growing 29%, professional services growing faster. And if we flip this over, the professional services growing 29% over the last 5 years, subscription growing 42%. So anyway, a really cool view that you can see multiple businesses, but obviously subscription is the business. Where do they operate? 67% of the business is in the US, 16% in Europe, Middle East, and Africa, 10% in Asia, and other geographies, 7%. So 2/3 US, but fairly diversified.
Yeah, it is.
From a geographic standpoint. Another view that I just absolutely love. Okay, business quality time. I have a feeling I know how this is.
There's a lot of green here.
Yeah. How predictable is revenue? Highly predictable. Subscriptions run 1 to 3 years and 95% of revenue. So the customer makes no fresh buying decision each period, and the base renews by default. Best case scenario, right? Can it raise prices? Okay. Falcon is embedded across a customer's whole estate, and subscription margins are rising while customers keep buying more. So prices move without volume leaving. So
I mean, that's everything right there.
Yep. Okay. Customer absorb more spend. Module adoption reaches 51, 35%, and 25% of customers on 6 or more, 7 or more, or 8 or more. 51% of customers have 6 or more modules.
So when this company came public, I believe there were 9 modules total.
Yep.
Now I've stopped keeping track because it's over 20 now. But this is the double whammy because it shows that they have optionality. There's new modules that they can use, but each new module also makes the switching costs higher. And by the way, there are network effects here as well.
For sure. And when it comes to optionality, it's a buzzword. We've found out the hard way. Needle moving optionality is actually what matters. Having lots of options doesn't matter so much if they're not significant enough to actually grow the business.
Correct.
Is it recession proof? Definitely recession proof. Enterprise security, you have to pay no matter what. Your
vitamin painkiller?
Yeah, this is a painkiller product. It's not a vitamin. Yeah. Competitive position. This says average. Okay. Falcon is a differentiated single sensor platform growing with a fast market, but cash returns sit below the peer median and no share lead is named. So it holds no clear edge. Okay. The 10K says no competitor currently has a true platform equivalent to Falcon, which delivers 32 modules on one sensor. It's fast growing, but its market share is undisclosed and returns lags the peers. Free cash flow margin of 27% sits below the 29% peer meta. So
part of that's because a lot of the others are on-premise, which believe it or not, on-premise is cheaper because you just ship the code and it's on-premise. You don't have to pay for the cloud. So the cloud is a much more convenient thing for customers, though.
It's better all around. It makes everything more predictable, but it is lower gross margin in particular. It's 80% gross margin versus 95.
Yep.
So it's only merely fantastic. It's not stellar. All right. But either way, to me, this is a 5 out of 5 business. Like checks so many boxes in exactly what I'm looking for personally. So that's what we're going for. Okay. Phase. Which of the 5 phases of the business growth cycle is the company in? Okay. CrowdStrike says phase 3, the business is profitable and reinvesting all cash back into operations. Revenue is up, it's making money, and all cash payouts. Now, this is an important point. If you remember from this page here, the company is not profitable on a net basis and not profitable on an operating margin basis. So it's quote unquote losing money. This was a big challenge for us to solve with Stock Simplifier. I think it has correctly identified it's in phase 3
because it's looking at cash flows.
Because we actually changed the profit metric depending on the type of business. So a capital light company like CrowdStrike, operating cash flow is the appropriate metric to look at, and that number is positive. And if you look back, this number has been positive since 2019. Yeah. So there's so much nuance that goes into us figuring out which phase it's in. So there's one example.
You got the right one though. That's correct.
For sure. This is a company that is profitable despite what the GAAP numbers say. Are they buying back stock? Yes, but dilution is still rising. So they are buying back stock, which you think, oh, maybe they're returning capital, but the share count is still growing. That to us is a phase 3 company. You're minimizing dilution. You're not actually returning capital. So a lot of nuance goes into, I think, saying that this is correct. It's in the operating leverage phase.
Yep. Totally agree.
For sure. All right. Moat. So let's look at the current size of the moat. So a statewide lock-in and a shared telemetry cloud are real, but cash returns are below the peer set to a narrow moat. So the lock-in is real. Deployments with a 150% net revenue retention rate. Returns do not confirm it. So again, it's saying, well, the cash returns, the cash margins are below their peer group. So that's giving it a narrow moat. It's bounded, not broad. Protection shows the install base. So not a rival return. Yep.
If I may just give my own opinion here, this is why we make you make the final call for every one of these stocks, because humans still are the best tool. This is, again, like your first draft. For me, it's wide. And
I agree.
Like if you have an outage that brings down the world for 24 hours and you still add customers, let me just say that again. You have an outage that brings
national news,
not international news.
Yeah.
And you still add customers.
And revenue still went up
to 5.
Yeah.
I don't care.
I totally agree. To me, this is a wide moat business. And module attachment keeps deepening. The recurring base is growing at an accelerating rate. So the moat is widening. So the module adoption continues to grow. The flywheel is spinning faster. Nothing material eroding. Yeah, to me, I totally agree. I think it has switching costs. I think it has.
So the network effect. Can we click on that for 1 second? I think it's the second one.
Yeah, you're right.
Yeah. So I loved introducing this company to people during COVID because it was an easy way of explaining. If you, Brian Feroldi, if your endpoint gets attacked by a brand new type of cyber attack, then CrowdStrike notices it and then sends an instant immunity to every other CrowdStrike customer. So the more customers there are, the more chances there are to have an attack, which is actually a good thing.
Yes.
Because as soon as that attack happens, it can be recognized and immunity can be spread. I mean, that is the very definition of anti-fragility, and not the type of network effect we're accustomed to in like a marketplace network effect, but still a network effect nonetheless.
The network effect is a term that I have used for years without fully understanding all the nuance that goes into it. Facebook is like the classic network effect.
Yeah.
But one way of thinking about it is, does adding one more user benefit me, the existing user? Well, if Facebook adds somebody from Sri Lanka to Facebook, how does that really benefit me? It doesn't really, we don't speak the same language. Our paths aren't going to come across. So that's not a network effect benefit to me directly. In CrowdStrike's case, adding a company in Sri Lanka that faces some cyber attack, because it learns from every single customer, updates the kind of central nervous system, and then populates it everywhere. Literally every new customer that signs up is a direct benefit to every existing customer. Yep. That is a much marginally, but absolutely, totally marginally, but I would argue is a true network effect, not a branched network effect.
And I would say this too. This is not something that is now unique to CrowdStrike. Like Palo Alto has some of the same things, but CrowdStrike was first, which means that they've always been the best choice if that's important to you.
For sure. Anyway, I'm going with you. I'm going to say wide moat, and the moat's widening.
Yeah.
Like no doubt about it. Okay. Growth. Okay. Analysts expect revenue to grow 23% next year to roughly 5.9 billion, call it 6 billion. A consensus draw from 49 analysts. So 24% compound annual growth rate. Current pace runs higher. Revenue actually grew a little faster in the most recent quarter. So the forward estimates assume a slowdown. Most of it is concentrated. Well, that's subscription, contracted, excuse me. And guidance is moving up. Full year net recurring revenue was raised to 27%, which calls for an acceleration over last year.
To just put it in perspective, revenue was growing at 20% in the spring of last year. And every single quarter, it's gotten faster to now it's at about 26%.
Yeah.
So the thing is, yeah, they are calling for a slowdown, but they've been calling for that slowdown the whole time it's been accelerating.
Yeah. Now, we already saw the growth number. Do you notice any difference here visually, by the way?
That earnings and revenue are in there.
Yeah. So, well, that was in there before, but it used to have the numbers. Now I show the growth rate from period to period. That. Yeah. So 125, 110, 92, 81. So you can see the actual growth percentage change. Now this is year to date versus last year. So
yeah, it's just comparing 3 months of growth.
Correct.
But basically it does mean that it grew 6% quarter over quarter.
Yeah. 29% of the last 3 years, 40%. Okay. Is the industry, it's growing. Is the industry a tailwind or a headwind? Definitely a tailwind. No doubt about that. And then finally, can new offerings drive growth? This is that optionality thing. When does the company have the ability to launch new products that drive needle moving growth? This is where their modules come in. So I'm going to go with 5 out of 5 again, especially a company of this size. Pushback?
Totally agree.
Okay, great. All right. Management. This is decent. Okay.
I wonder if the outage has something to do with that.
A founder-led team with a strong record against estimates, offset by 5 straight years of heavy dilution and a cash margin that has slipped 2 years running. Okay, so the owner is the chair. Founder George Kurtz has been chief executive since 2011, holds about 1% of shares outstanding, a stake worth roughly, call it $1 billion. I would bet that that number is actually higher.
No, that's actually what I see too. I just looked. He owns 8.5 million shares.
Okay.
It's worth about $1.8 billion.
Okay. All right. Dilution is the real cost. Stock-based compensation ran 21 to 23% of revenue for 5 straight years, and the diluted share count rose 10%.
You can't give a 5 if you're doing that. That's fair.
It's
part of.
Are they shareholder friendly? Better be read. Yeah, it is. Yeah. Okay. Two signals in the middle. Free cash flow margin of 27% sits below the mirror. It's harping on that point of the pure comparison. But anyway, so he founded it in 2011. He's the president, CEO, and director since 2011. He previously founded Foundstone, running it until McAfee acquired it, and then he served as McAfee's worldwide chief. He owns 1% of the stock outstanding. Do employees like working here? 3.8 out of 5.
I think that's not
pretty
bad,
good,
especially given the outage that they had.
That's pretty good.
I'm sure was not fun.
Yeah. Do they beat expectations? 7 beat in 8. Let's check execution. 100% of revenue beats, 100% of earnings beats, and this is the one that I care about. So revenue pretty much always beats. Oh, this is a miss.
Well, all right.
It was right.
I mean, right there.
Pretty much a meet. Yeah. So I'm going to say great execution. Definitely not shareholder friendly with the huge dilution. And the margins here, I would say, nope, I would say that's good. How would you rate the management team?
I give it a 4.
I would also give it a 4.
I'm a George Kurtz fan, just in terms of he got through. He's like Reed Hastings. He got through the quick stir debacle and came out stronger on the other side. Same thing with George Kurtz.
I mean, personally, I'm an execution guy. Right?
Does you want to give it a 5, don't you?
Does this guy execute? Yes. Yep. Yes, he does. He executes. I would give it a 5, but I'll go with 4 for consistency there. Okay, risk. No customer is above 10% of revenue. 95% of revenue is recurring, and cash heavy balance sheet. The usual frailties exist. No customer is 10% of revenue. The 10K names large dependencies on Amazon Web Services, a limited supplier base with no guaranteed supply, and privacy penalties. One overhang still live. The July 2024 incident still drives long sales cycles, customer packages, and pending security legislation. So, diversified revenues. Disruption?
So, here's the thing. I made a video today for my YouTube channel about how people were worried that AI could become a cybersecurity shield itself. It's really hard to know how this plays out, but what I think is that there's a strong argument to be made that CrowdStrike and Palo Alto are more important because of AI rather than less important.
But AI is going to be, AI is going to increase the attacks because it's going to be easier to attack, but it also bolsters the defense. I don't know. We went through a SaaSpocalypse framework a couple of months ago, and we were like, is this mission critical or is it like optional? This to me is something. It's not like you're going to go to AI and say, protect my company from cyber. Go. Right. So I would say disruption is worth monitoring. Outside forces, a platform that runs on infrastructure the company doesn't own. Its hardware suppliers carry no guarantee. Privacy penalties are scaled to global revenue. That might be a little too harsh.
Yeah, I think it is.
Some, and then the financials are great. So what would you give this?
I think it's a 3. Honestly, the biggest one is another outage.
For sure.
Or a huge breach that goes undetected.
A breach would be way worse than an outage.
Or at least an undetected breach. If someone had CrowdStrike and you find out later that it's been exposed for months and months and they didn't know, that's the big risk.
All right. Valuation time.
Woo!
The PE of 778, the PFCF of 124. So this is crazy high, right? And this is the downside of using multiple analysis. It's defaulting to PE because the company is kind of profitable. I would say price to free cash flow is the better metric to look at. So at the peak of the crisis, it got down to 46 times trailing. And if we look back in time, it kind of got to 36 times trailing price to free cash flow, currently 143. If you look on a price to sales basis, just let's do that. Price to sales basis. It came public at about 10 times sales.
Even when it was cheap, it was 12 times sales.
Right. Dirt cheap, it was 12 times sales. And it got up to, in the bubbles of 2021, about 57 times sales. Currently 42 times sales. Let's do a reverse DCF on this.
Yeah. So
and
I've got
specifically a split growth 10-year reverse DCF. So what do you think? Let's start with the net margin, actually.
So they have specifically called out many times for many years, and it's been unchanged, that they believe they can have a free cash flow margin of 38% on the high end.
38. All right. So this model is assuming they can get to their stated goal of a 38% free cash flow margin. They're not there right now, but that's their stated goal. So we're going to say, okay, assume that they can do that. Next, what is going to be their growth rate, revenue growth rate over the next 3 years?
So it's predicted to be about 22%. I feel comfortable bringing it up to 24 or 25. You can even do 25 because we're still going to see my point come through here.
That's about matching with what their last 3 years. Oh, we just saw that this rate has actually accelerated in the last year. So okay, we'll call it 24. All right. Terminal growth rate
giving a 3% terminal growth rate. I think that they can easily raise prices.
Okay.
To grow
and
faster.
Then required rate of return.
I mean, I use 10% on all companies just as like my kind of boilerplate. That's what I put in. I'm looking right now. Their beta, believe it or not, sits exactly right now where if you did the CAPM model, it should be 10% anyway.
Okay. All right.
So here's the so we are arriving at my problem right here. This is my problem. Is that to justify today's price, we put in 24% revenue growth over the next 3 years, which is above what is estimated. We gave a 38% free cash flow margin, which is 10 percentage points or 50-ish%, maybe 30, 40% above where it is right now.
Current numbers. Yeah.
We did not penalize them at all for stock-based compensation.
Right.
And they still need to grow 34% from year 4 to year 10 on average to justify I mean, if they keep trending up, that's great, but they're going to have to trend up to like 50% growth 4 or 5, 6 years from now in order for this math to work. Or if we could go up and change this into like a 15-year, because you could make the argument, but even then, so look, even if these numbers sit, we're saying that it needs to plateau at 20% growth per year for the net until what, 20? Shoot,
46.
They need to plateau at that until we retire in 2046.
There you go. So this company needs to grow its revenue 17% per year for 16 years after growing it 24% per year, plus get their margin up to 38%. For today's, not including any effects of dilution.
So that's why I bought it at the beginning of the year. I sold it at about a little bit higher than the price is today, and that's why.
Yeah. So this is what this model assumes needs to have to happen. So I feel pretty comfortable saying I'm extremely expensive.
This is a 1 to me.
Yeah. Great. Okay. So to review, awesome business in the operating leverage phase, wide moat that's widening, high growth potential, good management team, moderate risk, horrific valuation.
For a reason.
Yeah.
Like the 4 for the score, the 4.0, and a 1 for valuation, which I can't remember. Is valuation included in that 4?
It's not.
Okay. So the reason that it's a 1 is because it's a 4.
Correct. It's an extremely quality company, which the market obviously loves. It's obviously bid up, and it's saying it's down there. So this to me is a great company. I own it. Hold is probably pretty generous, but I'm going to go ahead and set a price alert myself and saying, hey, another 10% higher from here. I'm going to be looking to sell.
Yeah, you should, and then set your falls to like 168, because then it might get interesting.
Yeah, there you go. Okay, let's go ahead and say that. Are there any financials you want to look at here?
I mean, you can go to their their KPIs, and sometimes I like looking at that. But no, this got most of what I'm looking for. I do love looking at the dollar-based retention rate. So sitting at 115 is great. Gross retention sitting at 97 is great.
Yeah. So for those that don't know, gross retention is just churn. That's all that it counts for. It's just churn. 97, 98% churn is essentially nobody is leaving. That's incredible. The best case scenario is 100%, which is essentially meaning none of your customers merge, none of your customers go out of business, none of your customers decide to stop having your service. So again, sensational business, extraordinarily expensive. Before we move on to Palo Alto Networks, people ask, hey, what software are you guys using?
Yeah.
This is called Stock Simplifier. It is software that Stoffel and I have built for research and companies from scratch. And we actually have a pretty exciting announcement.
It's a pretty big announcement.
Yeah, for sure. Okay. If you are already using Stock Simplifier, thank you. We really hope that you're enjoying all of the benefits. There are some people out there that have not decided to try it yet for whatever reason. So starting today, we are announcing that we have a free tier of Stock Simplifier, If you sign up for the free tier, you get access to the dashboard. You get access to 5 years worth of financials. You get access to the price alerts on the stocks, and you get access to each of the pages. Now, you do not get access to the AI analysis. You only get 5 years worth of data instead of 20. You don't get access to the 1-page overview and stuff. But if you're interested in giving this software a try, kind of kicking the tires, and you do want to try it, we now have a free plan that is available. We just launched this today. We've been working hard on it for a couple of weeks. So we heard from a lot of people that were like, I want to try it, but I'm not ready to commit. Now you can totally try it for free. And to do so, just visit stocksimplifier.com/free. If you could share that link in the chat, you can go ahead, create an account, and start to build your dashboard, all that kind of stuff. Now, again, if you are on one of the paid plans are definitely better than the free plan. You get the AI analysis, you get 20 years of data, you get the 1-page overviews. If you're a pro plan, you get access to the export features and the dashboards, all kinds of stuff. But we are very excited to offer a free plan for people that have been interested in kicking the tires. So check that out if you've been on the fence. All right, next stock. Let's go back up here, and I'm going to do it from here. So cybersecurity, Palo Alto Networks. Let's go ahead and research this company, which is one that I know much less about.
That chart looks awfully familiar. Now, Brian, I'm just curious. Do you know what happened in early 2026 that caused both of those to go parabolic?
I'm just going to say AI.
Yes, but
I don't know.
Specifically, Mythos was in there, which was the Anthropic version that had to be held back because it was so powerful. They had to put safeguards around it. And that's when it just kind of hit everybody that, like, oh my God, cybersecurity is even more important now.
Oh, okay. So Dario, the CEO of Anthropic, scaring the crap out of everybody is good for Palo Alto's business.
There you go. And
that makes
CrowdStrike.
it anti-fragile. Now, interesting. This is a $300 billion market cap, so it's bigger than CrowdStrike.
It's been around 6 more years, which is pretty important because they got a lot of, they were there when cybersecurity became a thing.
16,000 employees. Let's check out the key metrics. Gross margin, very similar, 73%, but operating and net margins are both positive. Look at this though. Free cash flow margin, 38%. So there's proof that in theory, CrowdStrike can get there because Palo Alto is currently doing it.
Yep.
All right. Balance sheet, $3 billion in cash, $300 million in debt. Great balance sheet. Growth rate.
Not growing as fast.
High teens, 26% over the last 10 years. High teens over the last more recently. Free cash flow growing a little bit faster, so that operating leverage is kicking in. Valuation, 27 times sales, 220 times earnings, 32 times book, and 80 times free cash flow. Dividend yield, no buybacks. Oh, it is paying down debt though. So it is returning capital through debt pay downs, not anything else. All right, let's take a look. Palo Alto Networks sells enterprise cybersecurity, and its strategy is to replace a shelf of separate security tools with a few integrated platforms. One platform secured the network, another runs security operations and cloud protection, and a third, added in early 2026, governs identity. Okay.
Pretty important.
So they do networking security, security operations and cloud protection, and then identity protection. When I think identity, I think like Okta.
Yep. Same here.
Okay. A threat research and incident response arm, Unit 42, investigate breaches and feeds what it learns back into the product. Okay. Money arrives in 3 ways. That's a good turn of a phrase.
I like that.
Hardware and software sold once, subscriptions to the security services, and support contracts.
Okay.
The subscription and support revenue is recognized across the life of the contract rather than at the moment of the sale, which is what makes the base recurring. Almost nothing is sold direct. Distributors sell to resellers who sell to the customer, and the hardware is built by outside manufacturer partners rather than the company's own plants. All right. So quite a few business lines here.
Burkhardt is pointing out, for what it's worth, that identity and access is key for agentic AI.
Okay. Okay. Who is the buyer? The buyer is a corporate security team defending a network, a set of cloud applications, and now a set of AI systems, usually with these tools from several vendors. Large enterprises carry the business, including almost all of the Fortune 100, alongside service providers who embed security into what they sell, and government agencies. What are they buying is consolidation. The company's stated strategy is to fold disparate point products into one integrated system. So the choice is one architecture against a collection of separately bought tools. The alternatives are are named in the company's own filings: Checkpoint, Fortinet, CrowdStrike, Zscaler, and Wiz, plus Cisco, Microsoft, and Alphabet, which builds security into products the customer may already own. Government buyers weigh one more thing. Selling into a sector depends on certification. A vendor much hold to bid on. Okay. Revenue breakdown. Subscription is 54% of revenue, growing 19% per year. Support is 27% of revenue, growing 9% per year. Product, the least attractive business, is only 20%.
Now, when we say least attractive, we should just say the moat is usually lower on product.
Yep.
And the incentive to upgrade is lower on product because it's not automatic. The margins can be better, though.
It sure can. Subscription is decelerating. Support is decelerating. Product is holding pretty steady from a growth rate over years. Geographic makeup, 2/3 US, 1/3 everywhere else. This is very similar to CrowdStrike. It's almost like a carbon copy of it. All right. Is revenue predictable? Highly predictable. 4/5 of revenue is subscription and support. And an $18.4 billion of contracted obligations is already signed. So they have a backlog. Can it raise prices? Hardware prices went up because tariffs pushed costs up, not because the company chose to move them. And buyers have named alternatives they can shop with. So, yeah, okay. Somewhat.
Yep.
Is it recession-proof? Definitely. What's
No
their
doubt.
competitive position? Dominant. Cash margins run about 8 points above the comparison group's median and have stayed at 32%. So it's using cash returns on there. Anyway,
Same
business
thing.
quality, 5.
I mean, it'd be like a 4.5 just because I like it when it's all subscription.
Sure, fair enough. Okay. Phase. Okay. Stock Simplifier says phase 3, operating leverage. Why? It's growing revenue, it's profitable, and it's reinvesting everything. No buybacks or dividends. So if we look at the trajectory over a longer period of time, both up, both positive. Yes, they're buying back stock, but they're actually diluting, and the share count is actually still rising. No dividend. Makes sense to me. Phase 3.
Yep.
Interesting enough, both companies are in phase 3. Okay.
Mm-hmm.
Moat. The only cost of leaving reaches full strength here, and nothing else in the business reinforces it, which is why this is a narrow moat. One strong source. Switching costs reach top strength. The other four sit middling or weakest. Returns only half agree. Cash margins beats the comparison group. Reachable within a decade. For larger platform vendors can bundle security into whatever the buyer already owns.
I mean,
So
that's what
says
CrowdStrike's
narrow
already
moat.
kind of been doing.
What?
That's already what CrowdStrike's kind of been doing. They're the newer player on the block. They went from 9 modules to what was it, 32?
Mm-hmm.
So they're trying to. So Palo Alto hit a speed bump like 2 years ago on what they called the platformatization strategy, which was what it just said, trying to roll up a whole bunch of different things. And what they did was they started giving big discounts. The idea was that we'll give you the discount now, you get everything under one umbrella, and then we can raise the prices later.
Mm-hmm.
But that's not something that CrowdStrike's had to do because, and it's not Palo Alto's fault, it's just that CrowdStrike was cloud native. And so it was easier for them to do this.
Okay. Moat direction. One protection is deepening and the other is fading as the model becomes industry standard. So on balance, the moat is stable. Commitments are deepening. Contracted obligations grew faster. The model is becoming standardized and returns are not expanding. So it says 3 and 4. Let's dive deeper. How hard is it to switch? The platform runs network traffic, security, and identity. 18.4 billion of contract obligations. So leaving is expensive. The company names it, saying customers may face real or perceived switching costs when moving to it from a legacy security vendor and its products. Architecture and a tool replacing it means replumbing network traffic, security operations since February 26th, the identity layer, and all at the same time. And the commitment still deepens. Yeah, to me, I think this is too low.
I do too.
I would say 4 and 4.
That's where I would land as well. I am curious, what does this next one say?
The scale?
Yeah.
Network effect? Okay. A real data flywheel. Malware seen at one customer becomes a protection push to the rest. So shared threat feels generally improved with the size of the base. So this is exactly what CrowdStrike has.
Yep. It's just that they started doing it later. So they have, like, they don't have as many connected endpoints.
Customers do not transact with each other and gain nothing from another customer's presence except for the standard shared feed. So there's no marketplace here. That's fine. Every rival runs one too. CrowdStrike, Microsoft, Fortinet, and Zscaler all collect telemetry and comparable sales. So no participant or engagement figure shows up. This loop pulling ahead. Did we overrate then CrowdStrike's moat if Palo Alto Network has it?
Well, so this is where that first mover advantage comes in, right?
Mm-hmm.
So like if you were to go out today and really do your research, my guess is you would see that there's slightly more protection with CrowdStrike because they have so many endpoints out there already.
Yep. So
I would say it probably makes it so that it's narrow and widening, not wide and widening for network effects.
This is exactly why we have these deep dives built in for pro users so that you could read into the real details behind this. And if we were so inclined, I'm not reading that doesn't exactly make for great content. So let's just say if you are a pro user and you have questions like this, highly recommend reading the deep dives because they go deep into that kind of thing. I'm going to say 4 and 4.
I agree.
Okay, cool. Growth analysis. Analysts expect revenue to grow 24% next year. Consensus up across 50 analysts, matching the company guidance. It's faster than the trailing pace. So revenue is growing faster this year.
However, the next bullet point's very important.
Acquisitions do the heavy lifting. CyberArk and Chronosphere add $338 million in revenue in the last quarter alone. So the acceleration comes from deals, not organic growth.
Growth went from like 19 to 31% last quarter. And at first you're like, wow, but no.
Yeah. So that's all inorganic inorganic growth. So if you look at 7 years of data, yeah. So earnings are inconsistent. I'm sure there's a whole bunch of
there's stuff.
I have a feeling that if we look at this company's financial statements, we're going to see some very hard to analyze numbers.
Yep.
Because of amortization and cost. That's just the downside to being an acquirer, a serial acquirer. But yeah, the growth rate ebbs and flows. Let's just say it bobs up and down. While the overall growth is obviously up and very consistently, the growth rate does have some cyclicality to it based on, I'm guessing, acquisitions and the timing of acquisitions. Is the industry growing? Yes. Can new offerings drive growth? For sure. And they have not been shy about acquiring that growth. So definitely good growth potential. Management, 8 straight revenue beats and a cash margin well above the comparison group, whatever year. So revenue beats estimates in all the 8 last quarters, and free cash flow margin is very high. So beating on revenue and producing sky high free cash flow margins while doing it. Dilution is the cost. Diluted share count went from 500, up 23% over a 5-year period, with stock pay running 13 to 21% of revenue. So same thing here. They are not shy about using their currency to do it. The biggest bet is untested. CyberArk closed in February for $2.21 billion, the largest deal in company history, and 4 months is not a capital allocation track record. Okay,
just left
in 2025. Oh no!
Well, and he's still advising for the next 3 or 4 months.
Okay, and he founded another company, Nikesh Arora. He's been the CEO for 8 years. He owns 1% of the company. He's been at senior roles at Google and SoftBank. He holds $660 million and has run the shift from firewall vendor to security platform company. Do employees like it? 3.8 out of 5. Okay, that's actually better than I thought it was going to be, given that this is such an acquisitive company.
Yep. Totally agree.
When you have lots of acquisitions, it's very common for employees to go on there and say, this sucks, things are changing. So that's quite good. Do they beat? Yeah, let's check. Execution. I care about revenue execution. Beat. 100% revenue beats, 100% earnings beats. That's pretty good. They are diluting, as we saw, and free cash flow margins are strong. I'm going to go 4.
Same. Yeah.
Cool. Execution risk. No exposure here. Is company life threatening? The balance sheet carries net cash, but channel concentration and unfinished $21 billion deal are real. Recurring revenue, a base absorbs the shocks, a balance sheet that cannot fail, and real elevated exposures. 3 distributors are 44% of revenue. Out of curiosity, how do you weigh something like that?
I don't take away too much, because unless those distributors have their own competing products, yeah. I mean, so it's Cisco, Microsoft, and Alphabet, it looks like. That's something to make note of. Maybe that can be like a tiebreaker, if you will. Okay. But nothing huge.
Well, concentration risk is a pretty big part of the anti-fragile framework, and you penalize companies pretty severely. I'm just curious,
but they're not.
You penalize this company.
They're not end customers.
Okay, so if they're distributors, you're fine with that.
Then we might be having a different conversation.
Yeah, so this says moderate. I would say that that's a pretty good assessment. It's, hey, this is noteworthy, but not concerning. Is disruption a threat? Same thing with CrowdStrike. How much is inside their control? Tariffs, sole sourcing chip supplier in Asia, and one main contract manufacturer, but that's only on a minority of their revenue, and the financials are pretty good. I'm going to say 2. I'm going to say 4.
Well, but I will say the other thing, though, is the unnamed risk, which is a breach or a breach existing that we don't know about or a customer doesn't know about. So we can't forget that.
And the other side, since the strategy is growth by acquisition, that it does add an extra risk of management doesn't overpay, management doesn't make a bad acquisition, all that kind of stuff. So I would say that makes the execution here harder.
CrowdStrike has started making acquisitions, but not on the same level that Palo
I would imagine they're bolt-on to add modules, not needle-moving company betting kind of thing. All right, Mott, we'll go. This is riskier. We'll go riskier. Okay, valuation. Palo Alto reads steeply valued right now. PE of 306, price to free cash flow of 80. PE was way higher than normal. Price to free cash flow is way higher. than normal. This company was trading at, let's say, PE 50 times, 40 times trailing earnings. Now it's 300 times trailing earnings. Let's go to price to sales to even that out. So it was down to 7 times sales. Now 29 times sales. Oh my goodness. Yeah, even before the breach kind of thing, this is a company trading at 11 times sales, and boy, is the stock just taking off. I'm just curious if we go maximum here. The average is 10 times sales. It got down to as low as 4. Wow, now 28.
CrowdStrike is 44. Is that right?
Yep.
So I mean, the super expensive for Palo Alto is kind of like the normal for CrowdStrike.
This is a company that, quote unquote, has averaged 28 times free cash flow since it came public, although it's obviously never trades at 28 times free cash flow. Yeah. The number is highly volatile, but let's just say it's pricey right now. You want to do that same reverse DCF?
Yeah, let's do it. Okay. So this one could have slightly better margins. It's more mature. It'll probably get there quicker, and it has some on-premise. So I'd say you can do 40 or 41.
Okay.
I think we still want to give a 3% terminal growth rate. I think that's fair.
Okay.
Boy, I wonder if I check how volatile is this stock. The answer is, it's actually quite significantly less volatile. Let's do it 2 ways. We'll do the first one with the 10% discount rate.
Okay.
And then for split growth, they're going to average somewhere around 19% per year over the next 3 years. Acquisitions are part of that. So that makes it tricky. Mm-hmm. But when we look at that 25% growth that's necessary, what you need to know is that it hasn't been 25% growth without acquisitions since they have a weird fiscal calendar, since 2022, 2023. So it's been about 3 years since they've hit that. So assuming that they're going to be above that for years 4 through 10 is just as difficult. It's not quite as egregious to me as CrowdStrike, but it's still there. I wonder if we pull that discount rate down to 9%, how much does that change it? I mean, a little bit.
Yeah. Either way, to get to the numbers that are needed here, acquisitions have got to be a part of the picture. Right?
Yeah.
They have been historically. And again, 10-year, they've grown their revenue 27%, or excuse me, their free cash flow. Mm-hmm. Their free cash flow has grown 27%. Their revenue has grown a little bit slower than that. But okay, I would put that in the range. So to me, that number is high, but not impossible.
I give it a 2. So we gave a 1 to CrowdStrike. I give this a 2.
Yeah, there you go. Okay, so to review. Awesome business in the operating leverage phase. We gave the moats broad, and the moat is expanding, not as fast as CrowdStrike. The growth we gave, very good, right? Management here was just as good. The risk here is moderate, and the valuation is a little bit lower. While we're here.
Yeah. Well, let me say this. Let's go through the rest of these. But right now, everyone watching, we've got thousands of people watching. If you had to choose between these two, which one you'd put, and I'll see what wins as we finish up.
Yeah, one thing that I do want to check. One thing I like to check with companies like this, Palo Alto Networks. Now their balance sheet was really strong, but I do like to see if we kind of expand everything out here. How much goodwill does this company have?
Yeah,
goodwill. Yeah,
whoosh.
Yeah. So goodwill is the premium that you paid over the price of a company's the fair value of a company's assets to make an acquisition. Essentially, think of this number as money that was given to shareholders to get deals done in the past. So companies report this as an asset. This is, in my opinion, the worst asset you can have because it counts as an asset, but you get no balance sheet value out of it. So 21 billion in total assets here. Now, is that number manageable? I mean, yeah, it's a $300 billion company, right? And if let's take that off. If we take let's take goodwill off. So plenty of cash, like 3 billion in cash. Actually, just do cash and cash equivalents, about 3 billion in cash and cash equivalents. How are they paying for it? So debt is actually,
I mean, it's got to be just shares.
Yeah, that could be one reason that they are diluting. Let's go ahead and check the cash flow statement. if we expand all capital expenditures, common stock, well, that's dividend buybacks, other financing activities, the margin is there. Yeah, they have plenty of cash flow. Yeah, you're curious to see how they are financing their deals, but like you said, I'm sure they're doing quite a bit with their share count. If we just look at their share count,
yeah, I mean, look at how much. Yeah,
that makes sense, right? This is a $300-ish billion company, and they just made a $20 billion purchase. So yeah, this is not all stock-based compensation, right? The upticks you see in the share count here are very much acquisitions. Acquisitions being made. So the company's share count is rising there, but not necessarily by comparison. I'm gonna go back to that summary page. To me, I'm gonna put this also kind of same thing there. And I would say, let's go ahead and set a price alert. This is a company I do not own. It would have to fall pretty substantially. I'm gonna go $300 here. All right. So both businesses were excellent. CrowdStrike got a slightly higher average score than Palo Alto Networks did. Offsetting that, Palo Alto's got a slightly better valuation. But Mr. Stoffel, if you had to pick one, which one would you go with?
I would go with CrowdStrike if I had to pick one. I mean, and here's how, and that's the one I just sold. But what I would say is I would just say, you know what? Go wait until a better price comes along. I believe one will. I could be wrong. Or just buy a little bit.
Yeah. Okay. I will choose Palo Alto Networks.
Yeah.
I think it is if like, again, not which business do I like better. It's which better company is a better buy right now. I would go with Palo Alto Networks. The valuation to me is very high, but given their acquisitions, I think it's actually their growth rates are extremely high, but far more achievable. I think CrowdStrike's gonna have a really hard time executing at the rate that they are going at there. Palo Alto has a hardware component to this business, which from a financial perspective tends to be a negative, but from a Moat perspective actually can be a net positive in the long term. I think both of these businesses have tremendous future potential ahead. And as a reminder, CrowdStrike is the one that I actually own. But if I had to choose right now, if I was committing fresh capital, I would go with Palo Alto Networks.
Now that doesn't mean you're going to go out and sell it right now and buy the other, does it?
Well, I put a alert on CrowdStrike. If it keeps going up, there is a price that becomes, okay, the valuation here is so extreme that I don't think the company can live up to that.
Just real quick, we've got another minute. Do you ever worry if you do something like that about missing it? Is that, I mean, or is the fact that that's now included in Stock Simplifier kind of be like, you know what? I know I can get back into it because I'll get a notification when it hits a certain price.
I've done quite well with I've already done quite well with my CrowdStrike position, right? So it's like missing it. I don't spill milk about missing more upside potential when I've captured a bunch. Again, I am very reluctant to sell, especially winners. But there is a point when the valuation becomes so extreme that I don't think the risk of holding, given the valuation, compensates you enough for the risk that you're taking on.
For what it's worth, Carl went with option number 3, which was Zscaler, which we didn't talk about today, but he said, hey, that's the one to go with. There
you go. Now, as a reminder, for people that have not checked out Stock Simplifier yet, go to stocksimplifier.com/free, and you can create a free account of Stock Simplifier. You get access to the dashboard. You get access to the alerts. You get access to 5 years of financials, and you can actually rate each of the things on the stock. Now, you do not get the AI-assisted analysis that you have. You do not get 20 years of financials. You don't get the one-page overview. You don't get the advanced screening tools. There's a bunch of things you get when you become a paid member. So we think the paid members is definitely working it. But we do now offer a free plan. So if you want to kick the tires of Stock Simplifier, you can do so for $0 right now. stocksimplifier.com/free. And if you do that, we are always open to feedback about ways to make the product even better. So please.
One other quick note, Mr. Brody, for those of you that are watching on X, we've got thousands of people watching. And actually, I can see that Twitter is actually the majority of people that are watching. I put the link to that in the comment section for this video. So that's in there right now.
There you go. So thank you guys so much for joining us. We will be back next week with another matchup. Tomorrow is Wednesday. Our newsletter comes out every Wednesday, and we have some matchups in there for you guys to vote on. For example, we have like ASML versus Taiwan Semi. That's been one that people have requested. We've got Robinhood versus Hims and Hers, 2 stocks that we've always had on the bubble of research. So if you're interested in telling us what stocks you want us to research next week, do so in the newsletter and sign up there. Thank you guys so much for watching. We will see you next week. Brian's out.